This video on the multi-stage valuation model. And we're also going to be talking about how to approximate it using a two-stage model. Next, we'll talk about how the PolarisInvesting.com website calculates the valuation coming from each one of those two stages. And we're going to finish up talking about approaches between a trader, short-term trading, and being a long-term value investor. I'd like to focus your attention now to the left part of the screen, the graph, the green line. And this first point on the green line represents the current market price that we're assuming here, $30 for a hypothetical stock. And then from there, the green line moves, each point on the green line represents the rational price that's being expected in the market as time goes on. We're going through in this video how this number here is calculated, but 3292 is the valuation that's being it has been calculated is the present value of future cash flows. But like I said earlier, the green line starts off at $30, which is assumed to be the current market price. So when you can buy an asset for under its intrinsic value, you have an alpha opportunity. So what's being assumed in the first 5 years is that we'll be earning a little bit more than the expected risk-adjusted rate of return, also referred to as cost of capital. And when I scroll over here, you'll see here that we're assuming instead of this being 10% cost of capital, we get a little bit of extra alpha in terms of the return. And then every period after that, assume it's just the same as the cost of capital. So again, we start off here, market price 30, get a little steeper slope as we eventually converge with the valuation in intrinsic valuation in 5 years, and then from there on out it just grows at the assumed cost of capital. So the green line represents essentially normalcy, what we expect as a rational investor to happen with our investment over the foreseeable future. Well, next I'd like to bring in another line to the graph that represents more of an irrational in really what we can expect from the market price at any given time. And what's the difference between the green line and how the green line and red line is calculated is that over here, when we calculated the present value for the valuation, we built into it, and we'll be going through this in detail later in the video, but we built into it all these different growth rates that are being assumed for the life of the stock. Well, the red line, let's take this point right here, point 2, which corresponds to this row here. We're assuming that the market did account for 7% growth of earnings in the first year, 9%, just like the rational investor on the green line. Then here in the third year, we're assuming that the market becomes myopic. It's also referred to as presentism bias, but it now assumes that this growth rate will go on forevermore. So heat of the moment, some news breaks about the stock, market immediately reacts to it in an emotional way, and it just thinks that the current situation being reflected by its growth rate will just continue on forever. So that lifts it well off the green line up to this red line. And then as we just go from year to year, let's say out here in year 6, you're looking at a 2% growth. So the market, we're assuming, is been in line with the rational valuation approach, but then all of a sudden news breaks, and now the market overreacts and drives down the price of the stock, because it assumes 2% is going to continue on forever. So at any given point, we're on the red line, we're assuming that up to that point the market has agreed with the rational approach, but then at that instant in time it becomes myopic and drives the future, or assumes that the future is going to be that same growth rate for forevermore. So think of the green line as a long-term trend line of based on rationality and incorporating all these different growth rates. And then the red line is how extreme the market can get at any given time. But the red line is points on the red line are constantly being drawn back to the green line. The green line kind of serves almost like gravity, or is like a vortex pulling the market back to rationality. But you'll never know exactly when the market will come off the red line, how far it'll trend towards the green line. It can happen at any point. It doesn't necessarily have to be at these extremes, and then at some point equaling the trend line. The market can have bouts of rationality and irrationality at any given time, and move it quickly from the red line and closer to the green line. All right, next I want to talk about is how the points on these lines are calculated. And understand that I need to go through how the perpetuity valuation formula, which is shown down here in the left-hand corner, is derived. This is discussed in detail in other videos, particularly the PE multiple video out there on the Polaris.com YouTube channel. There's a playlist called Valuation Calculation. Like I said, the video is called PE multiple. But to briefly go through it, we're assuming here that an investor makes an initial investment, let's say in a brand new company, in an IPO type company, and the initial investment at time 0, so that's referred to as I naught. That's not the number 10, but I naught. There's some initial investment made, and that's at the beginning of the year. Now here at the end of the year, there's been throughout the year a cumulative return or earnings made against that return. And then at the end of the year, management decides to reinvest a portion of those earnings back into the company, and then 1 minus that amount that's being reinvested back in the operations of the company are distributed out to the stockholder. Now the distribution can take 3 forms: either a dividend, stock repurchase, where other stockholders' shares are being repurchased with the distribution that was earmarked for this specific investor. So it's kind of just trading off the distribution for a portion of stock, but assuming that the market is pricing the stock at any given time at the appropriate price. It's just a swapping of funds for another type of fund, namely stock. And then the third way is just parking of funds outside of normal operations. So in a money market fund typically, and it's not given directly to the stockholder, but it's kind of earmarked for the stockholder and just held by the company. So here in the second year, we still have the initial, at the beginning of the year, still have the initial investment that was made at the start of the life of the company by the investor. But now there's been a reinvestment made on behalf of the company, on behalf of the stockholder by the company, that is also now part of the cumulative investment that you have here starting in year 2. So when you do the calculation, it works out to this expression here. So now you take a return against that beginning year investment, and then a percent of that return is withheld, and then 1 minus that is distributed out. And you just continue doing that year over year over year, and you end up with this geometric progression in each column. Well, if we look at the leftmost column, the distribution, you can now do a present value, assuming some cost of capital, of all these distributions for the first in periods. And typically a period is a year. And so now these in years become known as a stage. And a stage is really, 3 things are constant during a stage: the rate of return that's being earned against the investment, the percent that management decides to reinvest of those earnings back into the operations of the company, it stays constant, and then the cost of capital is assumed to stay constant during a stage. If any one of those 3 values changes, you have a new stage, and therefore you're looking at a multi-staged model. But what you're looking at here is just a single stage. Now, the present value of all these distributions should look familiar to most people. It's just the perpetuity valuation model. It's also a form of the Gordon growth a dividend growth model, if you assume that this numerator here is dividends, and then this growth, which is R times the reinvestment, is the dividend growth. That's the classic Gordon dividend growth model. Now the middle term may be new to people, but it's just a way to cap off the perpetuity after n years. So if you have a stage that just goes for n years, not forever, this is a way to subtract off that perpetuity going beyond n years for forever. Now I do want to point out that the way that you cap it off, this term here can also be used in place of a form of this term can be used in place of the 1 if you want to delay the perpetuity, because this is assuming this stage starts right at time 0. But let's say you want to have a stage, well, an example I gave where maybe a rate of return or something changes and now you have a multi-stage model. Well, that subsequent stage is not going to start at time 0, it's going to start at time n plus 1. So if you want to delay the start of a perpetuity, you can use this expression here in place of 1, and then let's say you're starting at m years from now, then the exponent would be m, and then if you let it run for n years, then this second term here would be n to the exponent of n plus m. So you can have these perpetuities started and stopped anytime into the future. I want to point out that if you have just a single stage and you let that stage run forever, namely n becomes infinity, because you always assume the cost of capital is greater than your growth rate, this middle term, or this term here, will become 0, and so the middle term is just 1, and then you got the classic perpetuity valuation formula. Well, let's go back to the spreadsheet, and let's talk about where this first point on this red line comes from now. So we have, here's the growth rates. This is the growth rate for the first year. I scroll over here to the right, you see here that that growth rate comes from the return and the assumed reinvestment rate, cost of capital. So if we plug those numbers into this formula down here, namely there R, the reinvestment rate, the cost of capital, R times the reinvestment rate is the growth rate, and then you let n go to infinity, you get the first point on the line. Now the subsequent points, well, let's just do the next one real quick. 9%, and then using this data here, when you plug it into the perpetuity, you're delaying it now for 1 year. So now this 1 is replaced with expression to the first power. And the second expression is with n set to infinity plus 1, which is the same as infinity. And we plug in the values that we see here, and then we get that point, and so forth, going through all the different points on this red line. Now the green line is calculated a little bit differently, in that because it assumes that the growth rates only apply for 1 year at a time. There is no just getting to some point and then assuming that the growth rate goes on forever. So same thing though, is you take the values for that particular 1 year and plug them into the formula, but now it's just a 1 year stage, and then as you do subsequent points, years of and points on the line, you're delaying it into the future, but the n is always, if you delay it n years, this is always n plus 1, so it's just a 1 year stage. And then when you calculate the valuation that comes out of that for that 1 year, you add up all the 1 year valuations forevermore, and you get a valuation of $32.92. And then, like we talked about earlier, the way that the line progresses from there is you apply these initial first 5 years with alpha built into it, but these kinds of growth year over year, and then from there on out you just assume the growth is cost of capital. And now we've got an idea of where the different points on these lines come from. Just a quick reminder that the green line is your long-term trend line. It represents being very rational and keeping things in perspective year over year, and knowing that all these different growth rates will eventually materialize. The red line is market becoming myopic in any given year, and assuming that year's growth will continue on forever.
This video was originally shot in late 2018. Here in February of 2020, a significant world event has occurred around the coronavirus. Started off in China a couple of months ago and is now spreading gradually around the world. 15 reported cases in the United States, but over the last 10 days, the markets, namely the S&P 500, has dropped substantially as traders have worried about the potential for a pandemic to break out. Now, early detection of coronavirus is treatable, and they're also working on a vaccine that likely won't be available for at least a year. But in the short run, a lot of unknowns and a lot of angst in the marketplace that has really driven the market down substantially in a very quick amount of time. So as it relates to this multi-stage model, we can see how that angst is being factored into people's valuations. Let's assume that what we've been talking about up to now is a S&P 500 like index. It's been instead of being the current value, we're just going to say it's 3292, and recording what the current value is. And now let's say that here in the first year, instead of assuming a 7% growth of earnings, we lower our expectations down to 3.5%. Well, what that does to the valuation is it lowers it about 3%. If we go all the way down to maybe only a 1% growth versus 7%, okay, then we get a 5% drop in valuation. But the market is overreacting here in the short term, thinking worst case scenario. Not only going to see a drop in economic activity in the current year, but also well into the future. So let's assume that we go from 7% down to 2%, and then from next year 9% to 3%. Next year after that, 9.3% to maybe 4%. Okay, now you start getting into the kinds of drops that the market is building in. But that would require a substantial change in earnings growth outlook for multiple years to come. So this multi-stage model can give you some insight as to what's going on currently in the marketplace.
Well, now I want to talk about kind of what the underlying both these lines is the growth. So we've been talking a lot about those different growth values. Let's go ahead and bring them into the chart. And the way you read this is the left y-axis represents the different growth rates. The right y-axis is the prices that we're assuming for a rational investor, and then the market irrational line. One thing you notice right off the bat is that the blue line, the annual growth rates, shadows the red line, and that's fairly logical, because at any given time we assume that points on the red line would just represent the growth, that year's growth forevermore. But what's not as obvious is that even the green line is a result of all these different points on the blue line, and we went through that saying that they're just a bunch of 1-year perpetuities that you add up the valuations from and get the 3292. Well, now that we've got a clear driver of market prices and a clear driver of rational trend for investment value over time, let's just focus on that. I'm going to remove now the valuation green line, and I'm going to remove the market irrational price line. Now let's just focus on this annual growth year over year. Well, it's pretty unpractical to assume that an investor can accurately forecast growth rates, even in the short term, let alone out well into the future. I want to compare that to what analysts typically do. Analysts will, and I've shown this in other videos, so I'm just going to go through it quickly, is that if we assume here in 2017 an analyst is doing a pro forma, so what they usually do is pro forma income statements, and end up with some cash flow. In this case, it's free cash flow to the firm, but it could be other line items could be included. They could take it all the way down to free cash flow to the equity holder, or even down to earnings, whatever cash flow they're trying to forecast year over year. You end up with different numbers year over year, and as you transition from one year to the next, is just a growth rate. Now, to do it this approach, you're doing with very explicit numbers for all items for majority of items in the income statement. So it's a very detailed approach to do, but you end up with some kind of growth, and eventually you get far enough out. 5 years. This shows 5 years, but some analysts go all the way out to 10 years, thinking that they can explicitly forecast line items in income statement 10 years out. But then they eventually get to a point and say, well, we can't go any further. Then they just plug in the final cash flow that they explicitly derive into a perpetuity type formula that we've been talking about to end up with an overall present value for those future cash flows. But it really gets to be diminishing returns if you try to go further and further out in terms of time and trying to forecast growth rates. So we really need to come up with a different approach that prevents us from having to go so far out, or that makes so many different forecasts around growth. Well, one approach would be just to do an average. And that's what this purple line represents, is instead of doing, again, annual forecasts, just say for the next 5 years, we think on average the growth rate will be this. The subsequent 5 years. Now, these line up, the purple line lines up pretty well with the blue line, because I had I knew what the individual growth rates were, so I just averaged them. Typically, you're not going to know you're not going to forecast individual years. You're just going to come up with some method to forecast what you think the average will be for the next 5 years. But even if you do it across 5 years like this, you end up with quite a few chunks of 5 years that you would have to forecast individual growth rates for. And that's still too much forecasting. It's just impractical. Well, we're going to go ahead and go forward with the 5-year chunk approach, and we just cap it off after 50 years, and then just use the perpetuity, just like the analysts do, cut it off at some point, and then we just assume for forevermore that there's some rate of return. But anyway, when we do that, we end up with and we get the valuation coming out of each one of these 5-year periods. We add them up, we get $32.71. That's very close to $32.92. So it shows that it's a valid approach. You get a very similar number. So I'm going to go ahead and now hide the annual and say, okay, we've got a fairly equivalent approach by doing this. We just too much forecasting goes on. So now, could we go even further and do a 2-stage? Well, yeah, we can. In fact, we could even go further and do a single stage. We could say that it looks like about average growth over all these years is maybe like 4.5%, and it's going to go with one growth rate, one perpetuity. But that's somewhat like what we did on the red line. Any given point on the red line, we assumed at some point the market got myopic and assumed that a certain growth rate applied forevermore. But then we saw how on the red line the points jumped around from year to year as each year as the market reassesses the growth rate. You just see market in the real markets, you see that to some extent. It may not be for this exact reason, but the prices just jump around all over the place on reassessment. So if you go with a single growth rate, you're putting a lot into that one number, and it doesn't really give you much of a framework to even think about what the appropriate single growth rate should be for the life of a company. So it's better not to go all the way down to one stage, one growth rate, but to keep it at 2. And the advantage of 2 is you can focus on the reasonable future and where you likely can have a meaningful forecast. And then the second stage would be a mean reverted stage, that you would assume that things get back to normal, and we'll be talking more about exactly what we mean by mean reversion. But you get some growth rate that this is, for now, what we'll refer to as just getting back to normal. Well, that's what this approach up here is showing us, or this part of the spreadsheet is showing us. It's just a two-staged approach where we used this average in the second stage to represent normalcy. And when we do that, and we do the valuation for 5 years, and then the valuation coming out of the 5 years and beyond, we get $32.65, which is very close to $32.71, which is close to $32.92. So it shows that it's a very reasonable approach. So I'm going to go ahead and move or hide the 5 year, and now we've just got a two-stage model. Well, now that we've got it simplified down to just to a two-stage model, what probably strikes you as a lot is that here we are assuming a high growth of earnings here in the immediate future, and then 5 years into it, just a flip of a switch, we assume a major drop down to the mean reverted growth rate. Well, conceptually, that's a little difficult to kind of get your head around. So, many 30 some years ago, a model was created called the H model, and I invite you to go out to the internet and do a search on the H model or the authors of it, read a little bit more about it. But it's a fairly straightforward idea, and that is that when you have a two-staged approach, an equivalent way to look at it, a fairly equivalent way to look at it, mathematically, is to say that this two-stage approach is mathematically equivalent to assuming some high growth rate and then having a linear decline down into the subsequent stage, the mean reverted stage. And then this over here, these formulas show you how you determine, based on your average, what would be the implied initial high growth rate that you're assuming. Now, for high growth companies, usually the mean reverted growth rate is much smaller than what you initially start out with in terms of high growth. So if you assumed it was 0, then it becomes straightforward that you just multiply the average that you're going with times 2, and that tells you where you're assuming you're starting off in terms of a high growth rate as you drop down to this mean reverted growth rate. Now, I want to make sure you pay attention to what's going on right here at the transition. That since the Polaris.com site does assume a 5-year initial stage, here at around 3.5, 4-year time frame, we're getting this model, which is equivalent to this, is assuming that we're getting close to the mean reverted growth rate. In fact, we're going to go ahead and assume that the last year of this first stage, we're going to assume that we've already gotten to the mean reverted growth rate. Now I want to show you why that is an important factor to consider. Well, let's go back and look at how the perpetuity valuation formula was derived. When we looked at it, we assumed a single stage that made a comment that anytime you change your rate of return, your reinvestment rate, or your cost of capital, you are entering a new stage. Well, that's what we're doing here. Is when we have a two-stage model, at some point you do transition over to a new stage. Well, we got to talk a little bit more about how earnings from one year to the next relate to each other when you switch stages. So we need to understand really, go back through where does earnings, how does it get derived? Well, let's assume here that at the end of year 2, you finish up the first stage, and then enter a new stage here at year 3. Well, the earnings in year 3 is some new rate of return that's being earned against the cumulative the cumulative investment that you had at the beginning of that year 3. And where that accumulation came from is growth from the previous years. Particularly the previous year, you had a growth you had earnings, and then you retained reinvested a certain portion of it, or management did, back into the company that resulted in a even larger beginning of the year investment. But the year-over-year growth of investment, beginning year investment, is equal to the growth from the previous stage. So now when you calculate the earnings in this the first year of the new stage, you're applying a new rate of return times cumulative investment that includes the growth from the preceding year. So if you wanted to relate these two growths from year 2 to year 3 as they cut across stages, you would have to, if you wanted to come up with a term that you would multiply the year 2 earnings by to get year 3 earnings, you would have to, first of all, grow the previous year's earnings by the growth rate 1 plus g of that year 2's growth, which is stage 1's growth, which you get the beginning of year investment. But then you have to divide by stage 1's R and then multiply by stage 2's R. And just to make that clear, is that what we just did, the relationship between the last year's of stage 1 earnings and the first year of stage 2's earnings is this expression here. But if you assume, like we did with the H model, that really this last year of stage 1 has reached the same growth rate as stage 2, you can assume that the rate of returns are between those 2 years are the same. You can also assume that the reinvestment rates are the same, and therefore the growths are the same. So this first year's earnings of stage 2 is equal to the last year earnings of stage 1, because these terms are equal, of just 1 plus the growth of stage 2. Now that's an odd thing to conclude, because typically year over year the earnings grow by the growth from the previous year. But because of the assumption that we were making that last year stage 1 is return and reinvestment rate is the same as, well, now that we understand how earnings from the last year of the previous stage 1 relates to the earnings in the first year of stage 2, let's look at the valuation formula used by the PolarisInvesting.com website. It makes a further simplification, approximation about stage 1 value, where it just assumes that it takes the first year's dividend, multiplies it by the 5, which is the y, the number of years it assumes in stage 1. And then the second expression here represents stage 2 valuation. But instead of just starting with earnings and assuming some growth rate for earnings, the Polaris uses sales. So it says current sales times some growth of sales. There's a slider on the PolarisInvesting.com website that allows the user to put in their own assumed growth rate for the first 5 years. But then you multiply it by the future profit margin to get earnings per share company-wide. Then you divide by the expected number of future shares, and you get an earnings per share at the end of stage 1. At the end of stage 1. And then it's multiplied by future PE, and we're going to go through here in a little bit, show you how the future PE is the same thing as this perpetuity valuation formula. But what I back up here is that we left off at the end of stage 1. Well, if we go back and look at the formula that we've been using, is that in any given year, the return that you're making is on the beginning year's investment, but you earn a return throughout the year, and the resulting number of earnings is at the end of the year. So we've been left off at the end of the stage 1, but we've got to get to the end of the first year of the stage 2. Well, let's go back to the spreadsheet, and what we've got to simplify down to is this approximation is based on a 2-stage model, and showed briefly how the Polaris calculates the value. It again uses dividends and then multiplies by the number of years in stage 1. But now here in stage 2, it takes the earnings at the end of stage 1 and multiplies it by a future PE. And so now we understand how the future PE represents, or is the same thing as this formula that we've been looking at here, namely the perpetuity. How is it the same thing as a perpetuity calculation? So to understand that, I want to go back and do a quick review of what was discussed in the PE multiple video that I referenced earlier. Well, in that video we talk about how a price, or in this video we refer to it as really a valuation, but it's just the if you assume a constant growth rate forevermore, it's this formula that we've been looking at, namely this formula here. Where you use the next 12-month earnings, so that's a forward-looking earnings, and then the perpetuity formula is in this part of it. Well, you can also rewrite that to be the trailing 12-month earnings times 1 plus a growth rate, then times the perpetuity formula. And then you end up with a PE. If you divide both sides by the trailing 12-month earnings, you get an expression for the PE, which is 1 plus growth times the perpetuity formula. Now the question comes into what is growth once you hit stage 2? Well, it's year over year when you assume in stage 2 that you've mean reverted, which means that the return that's being earned is equal to the cost of capital.
Then year-over-year price appreciation, including reinvested dividends, is equal to the cost of capital. So the growth of the investor's investment is equal to the cost of capital.
Also, assuming the return equals cost of capital, this formula simplifies greatly, because you end up with some common terms that drop out, and you end up with a very straightforward expression for PE trailing 12 months, which is 1 plus cost of capital divided by the cost of capital. So we go back and look at the spreadsheet here in this calculation. That's what we did, is we took a future PE, and it's just simply 1 plus the cost of capital divided by the cost of capital, and then calculated the valuation, added it to the first stage, and then came up with a price of $33.28, which is very close to $32.65, which is close to $32.71, which is close to $32.92. One last thing I want to point out about the two-stage growth model
Is that the earnings growth shown here for stage 2 is a management decision.
It's driven by the amount of reinvestment, because we're assuming in stage 2 that the return that's being earned is equal to the cost of capital.
So the total price appreciation that occurs year over year
is really independent of what management decides to do in terms of reinvestment. Because if they choose to not do as much reinvestment and give more back to the stockholder, that's just more dividend, but that they just reinvest it and earn the cost of capital. Or if the management keeps it and earns the cost of capital, it doesn't matter.
The price appreciation year over year is going to be the cost of capital, assuming reinvested dividends.
All right, let's go kind of recap where we've been here, and I'm going to remove now the 5-year growth and kind of go back to where we started from with the valuation green line and the market kind of irrational, myopic-driven red line. Well, one approach to be an investor would be to be a value investor based on fundamentals, which this video has been primarily the growth. Stay the course, regardless of what's going on in any one year. Stay confident in your forecast of what's going to happen into the future. Things will normalize, and over time things will just stay on the green line. and then you just wait for, you let the mob have its day, and then you just wait for the price to be driven well below where you think it should be long term, and then when it gets way above, you decide at some point to sell. But exactly when you would do that buying and selling is not really a strong point of that green line. The green line is just kind of saying here's an overall trend that we think, but it tells you kind of what. It doesn't really give you specifically when. And so now as you're sitting there day to day and you're seeing the market going from extreme highs and lows, being driven by enthusiasm one day, and then the next day or a couple weeks later you have a lot of despair and angst in the market, and you just have prices moving like they do and pretty volatile, and maybe you'd like to participate in that, and just to sit on your hands and be patient, and particularly as the market falls, that's when it's really difficult to remain patient and totally invested and just let things play out. So let's say you want to get a little more involved in trying to play the red line, or participate in the extremes, ups and downs of the overall market movement. Well, that is well beyond what we've, or quite different than what we've been talking about so far in this video, because the video has been primarily focused on the trend line, the green, and how that's derived, and really being a long-term value investor. Well, there's three approaches that have come up, general approaches that you can use around playing market timing and knowing when to possibly do a trade. One is technical analysis, and I'll assume the viewers watching this are familiar with technical analysis. The other approach is relative valuation, and people may not think relative valuation is a trading type technique, but it actually is. And then a third type would be based on more probabilistic approach. Well, let's go back and talk about relative valuation and why it's more of a trading approach. Is that it is very similar to what realtors do in terms of coming up with a price for your home. Is they go out and look at what's sold recently in your neighborhood, and come up with something like a price per square foot. Look at the square footage in your home, multiply it together, and you end up with a price. Well, they don't try to explain why prices in your neighborhood are what they are. It's just they are, and then that comes up with a number that can be applied to your house. But you can do the same thing with when you do relative valuation with stocks. As you go out and you look for comparable companies, but which, by the way, getting harder and harder to find exactly comparable companies. But assume you can, and you get a pool of these companies, and you end up with some metric like price per sales, and then apply that price per sales ratio to the sales volume of the company that you're looking at, and come up with some price that relative speaking to other comparable companies that you feel like the stock should be trading at. You don't know why. It's not trying to answer why. It's just this is what you think it should be, and then you would do a trade based on that relative valuation. Now, relative valuation leaves lots of questions. One is, who's to say those other companies are priced appropriately, and therefore the metric that you used, or the ratio that you end up calculating, why is that the right ratio? Why isn't your company the one that's currently priced correctly? And so anyway, you get into a lot of questions there, but that is the approach, and it's the approach that a lot of analysts use, because their careers depend on them, showing value yearly. They can't just necessarily sit on their hands and wait years for some of their positions to play out. They don't have, their career can't survive years, so they are forced to kind of get into this anticipating market enthusiasm or sentiment at any given moment in time. All right, the third way is you can try to do this is through probabilistic approach, where you look at historical macro and company-specific events. You try to get some idea of the frequency and the outcome from those events. What percent moves that typically are made when those kinds of events occur, and then usually most people will use some kind of like a normal curve and do a random selection of what event could occur based on the historical frequency, and then just play a probabilistic game going forward. That's what long-term capital management did. There was a company back in 1994 that had an illustrious 4 or 5 year career that was really based on this idea of mean reversion, which is really what the green line really represents, is that you assume some normalcy after time, and long-term capital management was playing mean reversion, or was planning on mean reversion across all kinds of asset classes. And then when eventually things didn't normalize in a reasonable time frame, they just didn't have the liquidity to stay afloat, and banks had to step in to bail them out. And that kind of goes back to the John Maynard Keynes, famous economist from England, who said that markets can remain irrational, often can remain irrational
longer than you can stay solvent.
So, this idea of mean reversion is a useful concept, but it's not, you can't universally apply it. So anyway, thanks for watching the video. We covered a lot of things, and talk to you soon.